The RBA says that low-income earners equate to about 1/4 of Australia's mortgage book. Of this group, the number in mortgage stress has increased from about 25% to 45% in the past year. Today's Financial Stability Review has also revealed about 16% of existing home loans are unable to be refinanced, either due to falling property prices or rising interest rates. Joining me now on the set is BetaShares economist David Bassanese. David, thanks for your time. Let's start with the RBA. Obviously kept rates on hold this week at 3.6%. Do you think they're going to lift later this year, or is 3.6 the limit?
Look, I think it will be the limit. I think we are seeing signs of consumer spending starting to slow. We do have a whole bunch of fixed rate mortgages that are going to be reset over the next few months as well, which is going to put further strain, as you mentioned, on some households. So on balance, I think, they are going to be on hold now. I think they're done. But yeah, again, subject to the economy, of course, and the inflation numbers. But assuming they pan out well and growth does slow moderately as expected, then I think they've done their work.
Yeah, the governor keeps talking about Australians being on a narrow path, our economy. How close are we to a recession?
Look, I think I don't think we're close. I mean, what keeps me most confident is the fact that wages growth in Australia is still, people complain about wages being low or not high enough, but the reality is it's meaning that inflation is at least the demand side of the economy is not driving inflation. It's more of the supply side factors, and as they peter out, then inflation can come down. So provided wages remain contained, the RBA can support the economy if need be, and so that means we don't need to go into recession. So again, if there's a negative shock that the economy does slow too fast, the RBA can quickly change course and cut rates. If inflation and wages were high, it wouldn't be able to do that.
The Governor spoke yesterday. He doesn't like using the term mortgage cliff, but there's a lot of people moving from fixed rates this year, about 880,000, to floating rate mortgages. How much of a concern is that for the Reserve Bank Governor right now?
Look, it's going to be, so it's unusual. We had a big surge in people taking out fixed rates during COVID, right? Interest rates were very low. The RBA cash rate was at zero. So it's worth watching. I mean, there's a lot of analysis. I mean, I think the cruel aspect of it is that it's going to help. Overall, it shouldn't have a major macroeconomic impact, but it is going to particularly hurt a narrow slice of households. So there's a narrow slice of households that are going to be particularly hard hit. But because it's still a relatively narrow slice, it shouldn't have a major macro impact on the economy.
We've got a chart we can put up on the screen, but basically it's some research you've done showing fixed rate rollover is the equivalent of 5 rate hikes. That seems like a really steep increase for someone's monthly repayments.
Yeah, so the way it works, what the RBA have estimated is that the rate rises to date have increased the average mortgage rate for all households by about 2%. So across all mortgages in Australia, the average rate's gone up by about 2%. And that's with 350 points of rate rises by the RBA. The RBA themselves estimate that there's going to be another 0.7% increase in the average mortgage rate across all mortgages, which is about a third of the increase we've already had. And so a third of the 350 is another, 125 points of tightening, which is about, 5 rate rises if they do it by 25. So that's how I've come up with that number. Mm-hmm. But it basically means the tightening of policy coming through the fixed rate mortgages is equivalent to about 1/3 of the tightening we've already seen from the RBA over the past year.
And there's more fixed rate mortgages coming off next year as well, right?
Yeah, so the bulk of it is this year in 2023, and then there's another component. So again, of that 0.7 increase, about 0.5 comes this year, and then another 0.2 next year.
You look around the world, though, rates much higher in New Zealand. The governor over there lifted rates to 5.25% yesterday. England, they're higher. US, they're higher. Yeah. What's so different about Australia? Is our governor taking a bit of a gamble here with interest rates?
Look, there's two key differences. Firstly, as I pointed out earlier, wages growth in Australia is still relatively subdued, just over 3% on a national basis. In countries such as the US and New Zealand, they're a lot higher. So the labour market is a lot tighter and it is showing inflationary pressure. Secondly, a lot more mortgages in Australia are variable rate. And as a result, more of a given increase in short-term rates from the central bank flows through to households. And so that is a big difference from countries such as the US in particular. So, and look, at the end of the day, the RBA is not as hawkish. Generally thinking, I think, as a philosophy as some other central banks. So they're prepared to give the economy a bit more benefit of the doubt and sort of hope that inflation can come down without necessarily having to drive the economy into recession.
Well, we get those March quarter inflation figures in a couple of weeks. Obviously, the Reserve Bank's going to look at them closely. But what are you expecting? Are we going to start seeing deflation in retail stores soon? Prices dropping, discounting? Is that going to start?
I think we are seeing it. So when you think about basically you've got goods and you've got services. So we had a surge in goods prices through 2021, 2022. A lot of those goods prices are coming off. So goods inflation is coming back, but service inflation remains sticky. Things like haircuts, travel rates, hotel rates, these are the things that are holding up at the moment. But broadly speaking, overall inflation should be coming down. We did get a couple of monthly CPI reports for January and February, which were lower than expected. And if that should feed through to the quarterly number, which again should show that inflation peaked late last year in the December quarter. And as a result, if the number does come in, showing an easing of inflation, the RBA, I don't think will feel the need to raise rates again in May. And therefore, we've got 2 months where we can wait and see to what extent consumer spending continues to slow. And over that period, they'll probably decide, they've done what they need to do.
And what about a cut? When could we possibly see a rate cut?
Look, I am penciling in an interest rate cut later this year. Interest rates are above their normal level. They are at restrictive level. So as inflation comes down, as consumer spending slows, I think Melbourne Cup Day is a good chance for a rate cut.
Really?